Hello everyone, welcome to our discussion of cost estimation. This is chapter 5, a little bit out of order, week 2 of our cost accounting class. So we're going to skip a couple chapters and then we're going to come back to 3 and 4. But I want to talk about estimating costs and how we do that. So the first question we want to ask ourselves is, why do we want to estimate costs? All right. So here's the thing. Accounting gets kind of a bad rap sometimes for always looking backwards and looking at what already happened. And we're going to do plenty of that in this chapter. But our idea of looking backwards is really to see what patterns there are in our costs so that we can project the future. And the reason why we want to project the future is we want to project what's going to happen if we make various decisions. So the past is sometimes a good indication of that, because what we're going to try to use is the idea that there's a pattern to what's happened at the cost in the past that will repeat itself in the future. And of course, we're looking at that whole idea, like we talked in chapter 1, about the value chain. Is this cost going to provide enough value for our customers? So, of course, if we don't know what the cost is going to be or have no way to estimate it, it's really hard to decide whether something is going to provide the value, because we're already probably estimating the value. All right, so if we don't have anything to compare it to in terms of, then we do things without knowing whether the value exceeds the cost. And again, we understand that there's going to be uncertainty, but if we don't at least give it a shot, at least we don't look at it and consider it, then we really are flying blind into decisions. So we talked about this concept of the difference between fixed and variable costs, right? Back in chapter 2. So fixed costs are those that don't change with volume. Variable costs are those that do with volume. All right. Remember, fixed costs can change, but not because of volume. And then on the per unit side, it goes the opposite, right? Because fixed costs, as you make more of stuff, the cost itself doesn't change, but the number of units that can absorb that cost goes up, and so the amount of cost each unit goes down, but per unit variable costs tend to stay the same. So we are looking at trying to apply different ways that we can estimate the cost of opening a new center. And again, what we're trying to do is really estimate the cost behavior. Is it fixed? Is it variable? Is it going to go up with our increase in volume? Is it going to stay the same regardless of our change in volume? That's going to help us produce some type of estimate going forward of what it's going to cost, so we can compare that to its value. So the first one is probably the most difficult to teach. We're not really going to get into it because this is beyond kind of where we would be at in an introductory cost accounting scenario. It really, though, does enhance the idea of looking forward. We're going to create a plan, a model, maybe even in a computer model, that is going to help us see what costs will be necessary. Okay? So we're going to identify these activities that need to happen before they've happened. We're not going to rely as much on the past. However, you should understand that any estimating software, even artificial intelligence, which would be the kind of idea of an engineering estimate, is because it's run a certain algorithm over and over and over again and come to a particular consideration. So machine learning or artificial intelligence is based on past experience still. So even engineering estimates are going to be based somewhat on our past experience, but that we really are trying to see what is it going to what's the theory about how much it's going to cost us. So this has some advantages. It's very expensive, hard to do in many cases, and it tends to be a little too theoretical for some folks. All right, and new activities are really based on some type of model. Okay, count analysis method is the second, and this is far more common and rooted in things that we can see. Now, the issue with count analysis is this is again a method that is important, but it tends to be something you learn through experience. Okay, so I'll teach you, we'll talk about some principles that go into it, but till you've dug into the detail of something like that, it's really hard to say this is how it happens. Okay? So we're going to review the actual journal entries, the data, the T accounts, if you will, that show the individual transactions, and try to identify each cost as either fixed or variable. So literally, if you were trying to look at your utilities cost, okay, you might look at your general ledger and all of the debits to utilities expense over the course of a year, 2 years, some period of time. Your first step would be to literally look to see if there's anything in there that's actually not utilities. Okay, mistakes get made. Okay, and we probably weren't too worried about it as long as it was an expense. If it went in utilities as opposed to maintenance or something like that, you probably didn't care from a financial accounting standpoint, because either way it goes to the net income the same way. But now that we're trying to understand our costs, having something internally, having something that's not utilities in the utilities cost is a problem. So the first thing we do is go through and say, okay, that shouldn't be there. Let's move it. Let's make an adjusting entry. Let's get that out of there. So all we have left are the things that are actually utilities. And then we start looking at, okay, this utility, okay, cost is for trash removal, and we pay the same amount every month regardless of how much we do. It's just a flat fee we pay for garbage collection. And that would be fixed. So literally, by looking at the nature of the cost and understanding what the situation is, we identify fixed, and then this particular gas bill is entirely based on how much gas we use. And we only use gas to make our product. We don't use it for heat or anything like that. We use that for electricity. We use electricity for that. So whatever propane gas, to say, for instance, we use must have been used in our production process. And so therefore, that should be variable, because the more of the production process we do, the more things we make, the more gas we'll use. So we literally have to wade right into the detail and start dividing it into piles of this is what's variable, this is what's fixed. While we're doing that, we might as well start working on, well, how much variable? What is the cost of it, since we're already looking at it Okay, what is the cost per BTU of gas that we're paying? Okay, let's make a note of that while we're investigating this. So here's a example that's not near enough detail, okay, as to what you might do if you're looking at, for instance, a total overhead type costs, and you consider office rent, utilities, administrative support. So again, we're talking about adding a new building or whatever, and running that building for this example. You would look at all of the costs, and in this case, you've got like an office rent, and you would dig into the actual contract with rent, and from this perspective, it looks like we're paying a certain amount per month fixed, regardless of what happens, and then some variable amount, which doesn't, wouldn't be the norm typically we would expect, but maybe we pay based on a percentage of sales. Sometimes that is some of the mall types of arrangements. That is what you pay. You pay a fat fee plus the amount as a percentage of your sales. So that looks like that's what the situation is. And then we've done that with each one. We've dug into the detail to the various bills and so forth to find what is fixed and variable. Account analysis is just really valuable in that it helps you understand what your costs are. So we can later, we'll do some mathematical things that will give us some sense of what this fixed and variable, but it can't really substitute from really digging in and figuring out what it is. The costs are driving the costs, and hopefully get some ideas about how to make them more valuable as we do so. So after we're done, okay, with our breaking into two pieces, two piles, we take our variable cost totals and divide it by the number of units, okay, to get our variable cost per unit, and we take our total fixed cost. And then if we want to then estimate going forward, see, we're focused on the past, but hopefully the patterns that we're establishing in our account analysis are going to continue into the future. If that's the case, then we can calculate the cost at 720 repair hours, 960 repair hours, based on our variable cost per unit per hour times the number of hours plus the fixed costs. Its advantage is, again, like I said, you get familiar. You have to work with the individual costs. You get a better feel for what's happening in your business. But at the end of the day, we're not using a mathematical formula per se. We're judging. There are some costs that are going to be hard to know whether it's a fixed or variable. Some we're going to have, it's just not going to lend itself to account analysis. It's time consuming, okay? And you might find yourself tempted to sway the analysis one way or another depending on what you think should happen, what you think would be the better way to do it, rather than what is actually happening because you're using that judgment. Okay, not even having an evil intent or anything like that, just wanting things to look the way that they should. Now, the last one is using statistics or mathematical or, a computer software to analyze the costs. Okay, a lot more, not up to as much judgment. Okay, but you don't really get a sense for what is really happening other than what the software spits out as terms of the results. So my preference is, if you're going to work with this, is you would do a count analysis for those things that are readily identifiable, and the things that are more, iffy as to whether they're fixed or variable, then you would use the statistical cost estimation on those. That would kind of be a mix of these approaches. All right. So we're going to analyze costs within a relevant range. Remember, relevant range means what we most likely would do. Don't want to get too low of activity or too high of activity, because our cost behavior starts to get skewed when we reach those upper or lower limits. So
example, okay? We could use a statistical analysis. We could have our data, and again, we're gathering the past data to try to identify patterns that will help us to estimate the future. And our overhead costs, and we have labor hours, we have machine costs, and we've identified that for 15 months. Now, most of the time we want more data than that, but this will at least illustrate what we're talking about. All right? And so then we're going to utilize, the key thing is, our theory is that labor hours determine how much overhead costs we have. So our overhead costs depend on our labor hours. Or maybe they depend on our materials costs. So that when we have more labor hours, we have more overhead costs. Or perhaps the situation is the situation where we have more materials costs, we have more overhead costs. So one very quick and dirty way to do this is the high-low cost estimation. I'm not going to spend time on that. You can read about it in your textbook. It is not that useful in that it doesn't get real close. And we have such good computer modeling software that it doesn't seem worth doing. We can get a better way almost as easily with our software. But there's the way to do it and how you would use it. I want to get to regression analysis because that is the key that we're going to focus on. That's what we're going to work on. That's what's going to be in your homework and on the exam or the project for this first section. Okay, this is a much more robust mathematical approach to separating our costs into fixed and variable, because it uses all the data, not just one or two data points like the high-low method, which is why the high-low method is not very useful. If things don't change much, then the high-low method might be okay, but typically we want to use the regression. Okay, so here's the equation that we're trying to work on. You may recognize this y equals mx plus b as the equation of a line. You may have learned in a math class. Don't worry if you haven't. This is how it's presented in the textbook. It's just a rearranging. Okay, so instead of y equals mx plus b, we are taking y equals the fixed the intercept plus the slope times x. Okay, all right. So it's just out of order, and you can move things around and plus. So applying that to a business setting, instead of just drawing a line like you learned in a math class, okay, we're talking about this overhead cost equals the fixed costs, that's the A or the intercept or the B, whatever you want to call it, plus the variable cost per labor hour times the number of labor hours. So that's what we need. That's what we are going to use going forward. So when we interpret regression, and we'll show you an example in just a minute about how to make that work in Excel. Okay? Independent variable is the X, or that's what's going to predict. That's the activity. So in the case we just showed you, that is the hours, the repair hours. That is the activity. We think that the number of repair hours, okay, or labor hours, I'm sorry, labor hours is the X term. That's what we think is going to predict how much our overhead cost is. Okay? The dependent variable is the overhead costs, or Y, cost to be estimated. In this case, that's overhead. Okay? So when we've run it through regression into Excel, all right, we find that it's $34.63 per labor hour, and the fixed costs are $20,378. So if we want to calculate our overhead for a particular, predict the future, if you will, with 960 labor hours, if we predict that that's how many labor hours we're going to do, then we feel somewhat like that we can predict that our overhead cost, will be $53,623. 960 times the 3463 plus the 20,378 for fixed costs. Now, Excel provides you with some other information. Okay? Correlation coefficient R, and the coefficient of determination R squared. So this first one is, the closer the R is to 0, the worse it is. Okay? Closer to 1. We want a correlation coefficient that's closer to 1 than to 0. And R squared is what percentage of the change in our dependent variable is caused by our independent variable. So again, we're measuring how good our regression was. How much can we expect to predict? So for instance, if the R squared is 0.7, that means that we're kind of thinking that this prediction is going to predict 70% of the costs, the changing costs. Now, in real life, that's pretty good. We're not going to get 95%. We're going to get things that are 80%, 85%. In fact, if you have too close to a 1 or 100%, you probably have data that somebody made up instead of actually used, because real life doesn't happen that cleanly. So there is how it is based on the textbook in the exhibit, and reading from that and what that means. Okay? Now, we'll show you how that will play out in a second video. But I want to give you some warning about challenges that you might face with this regression process. First of all, you've got the effect of nonlinear relationships. It may not be a straight line. Remember, we're using the equation of a line, but what if it's not straight? What if it's curved? That can give some problems. Okay? They're outlier data. And that's one of the reasons why I told you in the account analysis problem, we want to get things out that don't belong, because outlier data, situation where 2 months of our electric bill got in 1 month because we did some data entry problems, could give you an outlier, could give you a problem with your data, and you're going to not find the right relationship. So you might want to throw out outliers or find out if those are mistakes in our data, that sort of thing. You may find relationships that don't actually exist. Just because they happen to move in the same direction does not mean that they are causing necessarily the relation. Okay? And other things, situations where it's outside the relevant range or doesn't fit some of our other assumptions that we have to make to make regression valid. Okay? So for instance, the first one, the first problem of nonlinear relationships is we assume that within the linear range that while it's not perfectly linear, this dotted line is not too far distant from this line. But when we get when we get too high of activity or too low of activity, notice how much different our dotted line is from the regression line. Okay? And we get further and further. So that staying within the relevant range will help somewhat with the nonlinear relationships. Okay? So near full capacity or small capacity is often a problem. Okay? So we're going to define a limited relevant range, or if we have higher level math skills, we can use a nonlinear model. Okay, the math involved is much more difficult, but it can be done. All right, so you can see the example of a graph here with an outlier. Okay, this is what was computed using this data, and see the solid line is without that data. So if there was a mistake, or if this is just a really fluke of a month, maybe it's utilities on a month that it just got really, really hot, okay, or something like that, or some other overhead cost, just maybe there was a breakdown, maybe there was, something really blew up at that, something that made this way out of line, okay, that you might want to throw it out, and it might not be a good way to utilize the data to predict the future. Okay, so sometimes it's a good idea to do a scatter graph. We won't do a lot of scatter graphs because the scatter graph really is only useful to identify outliers. Okay, but I think we will typically eliminate outliers by doing a good account analysis. All right. So sometimes we try to put too much data into our models. Okay, and again, think through the logic of each of the things that drive the relationship, rather than just chunking it into the spreadsheet and then expecting it to come out with something useful. You need to think it through. And again, understanding which is fixed and variable from an account analysis is a good way to prevent this from happening as well. All right, just a little bit about effects of learning. Okay, when you start learning something new, it takes you longer to do it. And then as you get better, as you learn more, you can do it faster. So that's going to impact your costs. So for instance, if you're looking at labor costs per unit of something, when someone is just learning it, okay, or it's a new product or something like that, there's going to be a high cost per unit because they're going to spend more hours. And then as they get better at it, they are going to be able to do it faster. And so your cost per unit is going to go down. And so literally we can model that, we can anticipate that by building it into our model, saying every 100 products of this we make, our cost per product is going to go down as our employees get better and faster at it, more efficient, until we reach a point where it kind of levels off, right? All right, so all of these have the advantage of relying on historical data as stuff we already have, but you're still relying on the past to predict the future. Okay? The more if you use computational rules, you can use a lot of data because you don't have to just look at it, you can actually plug it into the computer. Okay? But you must be aware that just putting lots and lots of data doesn't overcome other problems. All right, so reminding you about if you're missing data, that can be a problem. We talked about outliers. Okay, be careful with allocated costs. That allocated costs are things that you had no control of, that were not part of what we were working on, but got allocated to our process. They are probably not related to the process, meaning they aren't a good thing to include in our analysis. We are currently experiencing some serious inflation. How much is the cost increase in something that we're doing right now? If we use that cost is driven by inflation, and how much of it is by actual increase in what we have to do. And that becomes a little bit difficult when we experience inflation. And is that going to be a long-term thing? Is that going to go back away? Is that going to go back down inflation-wise? And so again, you've got this issue with estimating the future. And then make sure that you're comparing months to months, that you don't have a cost for 1 month that is activity for a different month or for a different time period or something like that. Make sure you're looking at comparing the cost for 1 month with the activity for 1 month in the same month. So here's the example that they used in the textbook. 3 different ways of calculating. And again, we're focused on the regression, the simple regression. Okay, that's what we're going to spend more time on. You can use multiple regression, which is using more than one variable, labor and materials, both, to see if they both have an impact. That's a little higher level mathematical analysis than that we're going to try to get into here in this class. So we're going to use simple regression. And then this Appendix A is going to show you how to use it. We're going to come back to that and look in a separate video. The Appendix B talks about learning curves. That's the idea that as you do things more, you learn, okay, and get better and faster at it, and we can actually use that in predicting. For instance, an example next where we talk about first unit's going to take 100 hours, second unit 80 hours, fourth unit 64, eighth unit. You see that's a pretty fast learning curve. We've already reduced our cost down from 100 hours to 64 hours over making 8 units. Okay? But at some point that will stop. But that's what the learning curve is. That's not a linear relationship, and therefore our line isn't going to be exactly what we would expect. But we can adjust for that and produce a reasonable scenario. All right?